In this video, we're going to look ahead to 2021 to see where we think the opportunities might lie across different asset classes. Now, if you do want to learn more about investing in economics, then why not sign up to our free weekly market roundup? There'll be a link in the description below me and above me. So now let's look at the opportunities across asset classes in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's start off by looking at US equity. The reason why we start with US equity is simply that it's so big. It makes up almost 60% of global equity markets. Now, it's the job of some analysts on Wall Street to forecast what profits we're going to get for the S&P 500. And they also come up with an estimate of what price target they've got for the S&P 500 at the end of each year. And these are the forecasts for 2020, which they made at the end of 2019. And here are the forecasts for the end of 2021, which have just been made. So in this third column, you can actually see those price targets for the S&P 500 for each of those banks and strategists. Then in the next column are the earnings forecast for 2021, and then finally the implied price to earnings ratio. So that would tell you the amount of exuberance which will be baked into markets at the end of 2021. And just for a bit of context, this is the history of the profits generated by the S&P 500 going back to 2005, with the red bit here on the right representing the year-end forecast for 2020 and for 2021. Now, what's a bit worrying is that earnings growth had stopped in 2019. That's before we had any sign of the pandemic. And that followed the boost in earnings, which was largely a result of that corporate tax cut from President Trump. So beneath me here, you can see the price targets for the end of 2020, which were made at the end of 2019. And up in the top right, you can see the forecast for the end of 2021. I think it's fair to say that this has been a really exceptional period for equity returns. So since 2017, the average rate of growth of equity markets has been about 13.7%. So if that trend simply continues to the end of 2021, we'd expect something like 3,700 for the S&P 500 at the end of 2021. But those forecasts are quite a bit more optimistic than even that very optimistic estimate. They're pretty much expecting that 14% annual growth will continue from where we are now until the end of next year. And those exceptional returns have been going on for some time since the global financial crisis, with the S&P 500 growing at almost 13% year on year. And if we extrapolate that trend, we'd expect the S&P to be somewhere above 3,800, which is at the low end of those broker forecasts. But it's always worthwhile taking a slightly longer term view as well. And if we go back to 1990, the average annual growth of the S&P 500 has been about 8%. And if we look at the periods when we were above that trend and below that trend, we can see that currently we're definitely in an above trend period. And we've been there since about 2016. And if we look at current valuations, they're at almost all-time records. And that's largely because of huge fiscal stimulus as well as monetary stimulus from the Fed. Now, some people think that just because interest rates are almost at zero and because of all that stimulus, that valuations don't matter. I beg to differ. I think valuations always matter. And in fact, I'd go even further to say that valuations matter most when people say they don't matter. If you're enjoying this video and you want to support us, you can now do that directly via YouTube. Just click on the join button beneath this video or in the description. That way we can remain independent, plus you get a lovely badge which is next to your name in the YouTube comments, also during our YouTube lives. Surely you wouldn't want to miss out on an opportunity to look this cool. So if the US is looking expensive, perhaps we can find value in other countries. This shows the cyclically adjusted price to earnings ratio. So that's the price of a country's equity index divided by the profits that country's index has generated over the previous decade, which is roughly one business cycle. And I've shown 3 countries here. I've got the US, which is in red, and you can see that's been steadily trending upwards in terms of CAPE. The green line is German CAPE, and there you can see Germany is significantly less expensive. And then finally in blue, we've got the UK equity market. Now, it's difficult to compare countries. So for example, if we look at the blue line, which is the UK, you can see that it's always fairly cheap relative to the other two. So an alternative way of looking at this is to say, what's the current value of CAPE relative to its own history, and we'll rate that as a percentile. So for example, we'd look at the current CAPE for the UK and we'd say what percentage of the time has the UK been cheaper than it is now. And here I've done that for all the countries where I have data which comes from Barclays. So you can see that yes, the US is expensive. In fact, it's only been more expensive about 9% of the time according to this measure, whereas Germany is looking pretty cheap, even compared to its own history. It's only been cheaper a quarter of the time. Now, one caveat is that some of these time series are quite short. So for example, for India and Sweden, we don't have data going all the way back to 1980. But now that we've had some rally after the news about the COVID vaccine, you can see that the UK is no longer quite so cheap as it was. It's roughly at a typical valuation. But what's clear is that if we look across countries, not all countries are equally expensive, and certainly not as expensive as the US. Another way of thinking about this is in terms of the recovery since the COVID crash. So in the graphs that follow, we're going to think about 3 times. The first one is the peak of the equity market before the big COVID sell-off, and that was February the 19th in 2020. The second time would be March the 23rd, when markets very quickly reversed. And the third time is the time when I made this video at the end of 2020. And these 3 graphs represent the returns for a Russian equity tracker here at the top, an S&P tracker in the middle, and a Chinese A-share tracker here at the bottom. But in the graph that you'll see in a moment, I packed together many more single country ETFs. And in those graphs, you're going to see 3 bars per country. The first bar will be the crash in red from the peak in February to the trough in March. The second bar will be the recovery since the trough to the time I made this video, which was at the end of 2020. And the green bar will show how much markets have moved from that peak in February to the end of 2020. So there are 15 single country ETFs on this graph, with Russia on the far left and China A-shares on the far right. And you can see those 3 bars for each country. And I've sorted by that value in green. So Chinese equity has had the best return since that peak in February, whereas Russia is still 16% below that peak. Now the UK is one of the worst performers because it fell by 40%, and despite the fact it rallied by 50%, that still wasn't enough to recover to the previous level. So it's still down by over 9% until the end of 2020. Whereas China never fell much in the first place, only 14%, but it still had a very strong rally in 2020, which is why overall it's up by 36%. Korean equity had a fairly large crash, but it also had a phenomenal rally. So if you are a bit contrarian and you think things are going to get a lot better, then you might go for some of these countries on the far left, which are still quite beaten up. Another way of looking at US equity is to look at individual sectors, and these have performed very differently. And this is the same kind of plot that we saw before. And in this case, the sectors which are still languishing are energy, real estate and utilities, whereas consumer services all the way up to technology have seen an incredible rally after their crash. And consequently, these are up by over 16%, or in the case of tech, up by almost 25%, since the February peak. So again, if you're very bullish on 2021, then you might go for some of these sectors on the far left, which is still below their peak in February. Or maybe go for a very cyclical sector, which is financials, which have been very hard hit because when there's a recession, cyclicals tend to sell off. Also for banks, their profit, which comes from lending, something called their net interest margin, is depressed when the yield curve is flat. So if you do expect things to improve, that and other cyclical sectors may be the ones that benefit. Next, we'll consider corporate bonds. So these are all graphs of credit spread. Now that's the additional income you receive for taking credit risk for various US corporates. And that's above the risk-free rate, which would be the rate on treasuries. So these numbers in red show you the median or typical spread that you'd receive for each of these credit categories. At the top here is the highest credit rating, which is AAA. Only a few companies have that. And there you'd typically receive about 0.7% more than treasuries of the same maturity in order to take that credit risk. A very small compensation for a very small risk of default. Whereas if we go for BBB, which is the lowest rung of investment grade credit, there you'd receive almost 2% typically for taking that credit risk. The highest notch of junk you'd receive typically about 3.2%, and as we get deeper into junk territory with single B credit, there you typically get 4.9% for taking that quite significant default risk. So that typical or median value is shown as this dashed red line in the graphs. Now, when we had the big March sell-off, it affected credit as well because people were much more concerned about firstly liquidity in the credit markets, but also an elevated risk of default. And here we peaked far above the typical levels. So for AAA, it was 2.4% credit spread versus that typical 0.7%. And in single B, it was even more extreme, reaching almost 12% compared to the typical 4.9%. But currently, you receive very little compensation for taking US corporate credit risk. 0.6% for AAA, which is below the typical value, and in fact for every credit category you're currently receiving a very small credit spread which is below the typical compensation. Now the reason for that of course is the Federal Reserve. So they stepped in with two credit facilities both in the primary market, that's the PMCCF, and in the secondary market, the SMCCF. Oh, and look, the turnaround in the credit spreads is timed exactly with the rollout of those two schemes. Then when they expanded the schemes, we saw an acceleration in the tightening of the credit spreads. So in other words, it's now very cheap for companies in America, the ones which are large enough, to borrow in the corporate bond market. But as investors, this has become a much less attractive investment. The whole point of investing in something like high yield is the fairly large credit spread which you typically receive. And we're still not out of the woods. Many companies have been weakened by the pandemic shock. So personally, I'd be a little bit cautious about allocating much capital to the corporate bond market, even though it is one of the few places where you can get a yield which is above about 4.5%. If we look at how much junk has been issued in the US over time, and the high yield bond market issuance is shown in beige, just look at that incredible level of issuance in Q2 2020. Clearly, companies realized that this might be the last chance saloon when it comes to issuance before markets start to normalize and maybe default rates pick up. But certainly there could be a widening of credit spreads which makes it more expensive to borrow. So what we've seen is the credit markets being swamped with lots of junk debt. And one unfortunate consequence of that is that in this crisis, we've actually seen companies take on even more leverage. And for the typical firm, but also the most leveraged firms, that's put us well above levels that we saw during the global financial crisis. And if we look at interest coverage ratios, so that's how easily a company can service its debt costs, the interest coverage ratios have fallen fairly dramatically as a result of that increased leverage. So I think that's a fairly unhealthy outcome for the US corporate credit market. Now, another way that companies can borrow is via bank loans. And in this graph, we're looking at tightening and loosening of credit standards for loans from banks to small firms and to large and middle market firms. So above the black line shows tightening of credit conditions. In other words, it's harder to get a bank loan. And below the line shows easing of credit standards, which is generally good for the credit market. And while we did see a very sharp tightening of credit conditions in the July survey, it still remains the case that credit conditions are tightening, at least for bank loans. Now, that's not just a negative signal for the corporate bond market, it's also a negative signal for the US equity market. So personally, I think this is another reason to be cautious about the US corporate bond market and taking too much credit risk. Now let's look at the gold market. And two of the primary drivers for that market are the strength of the US dollar, because gold is priced in dollars, and when the dollar's weak, that pushes up the price of gold. And this is the trade-weighted dollar, which is the strength of the dollar versus a basket of its trading partners weighted by the amount of that trade. Now in 2020, you can probably see that there's a little peak here because the dollar is a safe haven currency. And when equity markets were selling off, people were buying dollars because they were scared. But if you remain optimistic about the recovery in 2021, then you probably expect to see this weakening trend for the dollar continue. And of course, that will be good for gold. And in the bottom panel, I've got US real yield. And that's the yield on 10-year US inflation-protected securities, or TIPS. Now that has fallen very dramatically and it remained deeply negative in 2020. And recently you can see it's also been falling quite sharply. Now that's a positive for gold, because if interest rates are very high on low-risk US treasuries, then that makes gold much less attractive because gold is a wasting asset. It doesn't generate an income. So an even more negative US real yield is great news for gold. And I've created a very simple fair value model for gold based on those variables, but also CPI inflation, where the forecast of the model is shown here since the early 2000s in blue versus the actual price of gold. And it's not perfect, but it does a fairly good job of tracking the movements of the price of gold. But recently there's been a very clear divergence between what the model says, and the model's been driven higher by the weakening of the dollar, but also a fall in real yield, whereas the price of gold has fallen quite significantly since its peak during the equity market crash. So currently it's about 13% below that fair value model. So I wouldn't put too much faith into the model, I certainly wouldn't trade on it, but it does show that discrepancy between fundamentals and where the price of gold is at the moment. So if you are of a more cautious disposition and you also think that gold has been oversold, then this could present a bit of an opportunity, but it could also present a hedge if everything doesn't pan out as perfectly as markets are currently expecting. And while we're looking at gold, we could also look at silver. And I've built another fair value model for silver using the same inputs, and that suggests that silver is also trading a little bit below where it should be, but the discrepancy is not as large as it is for gold. Finally, we're going to look at government bonds. Now, if you'd invested $1 into one of these 3 ETFs which track US Treasuries, this graph shows you what would have happened to that $1. And these 3 funds represent 3 different maturities of US Treasuries. So here beneath me is SHY, very aptly named because it doesn't move much. It is a very shy asset, and that buys very short duration US Treasuries with between 1 and 3 years to maturity. And that's only up 2.1% on the year. And most of the returns came from that post-crash rally as people were seeking safety. Intermediate bonds are above me here on the graph, and there you can see that they're up 8.6% on the year, but the best returns by far come from the greatest maturities. So the TLT fund is up about 16% on the year, although since the summer you can see that it's been falling fairly steadily. But what I think this shows very clearly is that if you are willing to take duration risk, in other words go for longer dated treasuries, they provide the much better equity hedge. But that certainly comes with a huge amount of volatility, which is due to the long duration of those bonds. But whatever maturity you choose, these have provided a fairly effective hedge against the fall in equity prices in March. And what's also quite surprising, given the strength of the equity market rally, is that these haven't sold off much. I think if people were really completely convinced everything was okay, we would have seen these funds sell off a lot more. And if we are thinking about that hedging property of US Treasuries, here I've shown the rolling correlation between the price of those 3 funds, so that's TLT here at the top, IEF in the middle, and SHY at the bottom, just as it was on the other graph. You can see that the price movements have been fairly consistently negatively correlated, but more importantly, they remain negatively correlated with the US S&P 500 tracker, SPY. So if you see news stories saying that government bonds no longer hedge equity, then just do this for yourself. Plot the daily returns of equity versus the daily returns of these funds, and you'll see that there's still a fairly effective hedge. And furthermore, it's a hedge you're paid to hold. If you buy equity protection in the form of options, say a put option, there you have to pay a premium for the protection. This is where the government pays you to have a hedge, and that's pretty valuable. So personally, I think all of the scare stories saying that US Treasuries no longer hedge equity are simply not true. Now, one of the risks when you buy government bonds is that inflation increases a lot, in which case you might think about going for inflation-protected securities. Now, these do protect you against increases in inflation because the principal on the bonds, but also the coupon on the bonds, is linked to measures of inflation. And in this graph, I've shown US inflation in blue and something called break-even inflation in red. Now, in order for inflation-linked bonds to do better than nominal bonds, normal government bonds, the average rate of inflation over the life of a bond has to be greater than the break-even. Now, currently, inflation in the US, but also in the UK and elsewhere, is very low due to lack of demand. In the US, it's about 1.2%. in the UK about 0.7%, but it's well below that break even, which in the US is about 2%. In the UK, it's about 3%. So inflation would have to be considerably higher in the future in order to justify buying inflation-linked bonds. So if you think all this money printing is going to lead to hyperinflation or even very high inflation, then you would consider buying these instruments. But personally, I remain unconvinced that we're going to see very high inflation anytime soon. So certainly in my portfolio, I'm sticking with nominal government bonds. So to summarize, I think the asset classes which are most attractive really depend on your view of what's going to happen in 2021. So if we do see a normalization with some hiccups on the way, and the reasons why it might be choppy would be setbacks like lower than expected uptake of the vaccines or maybe mutations of vaccine-resistant strains of the virus, then in that case you might go for a slightly more cautious portfolio. So instead of going for high yield, you might go for something like investment-grade corporate credit, where you're not being paid so much to take that risk, but the sell-off in a secondary downturn would be smaller. Or you could mix that in with some government bonds, which, as we've seen, form a fairly effective hedge if there was another equity downturn. Or you could go for those countries or sectors which are still fairly beaten up that we saw earlier. Or you could make use of this complacency which we can see in markets by maybe buying some gold, which acts as a fairly good hedge against equity downturns. Or alternatively, if you think, woohoo, this is going to be another roaring 20s, you'd go for a portfolio which has a bit more risk in it. In fact, quite a bit more risk in it. So if you do think there's a risk of very high inflation, you'd go for inflation-linked government bonds, and staying with fixed income with bonds, you'd go for more risky forms of bonds such as emerging market sovereign debt, or high yield corporate credit. And then on the equity side, you'd go for cyclical equity. So those would be companies that would benefit from an economic upswing. And that, for example, would include things like financials and banks. You could also go for the more risky EM equity or possibly small caps. And personally, you can tell I'm color matched with the choppy normalization, which is here beside me. What's pretty clear is that markets are pricing in an incredible recovery. And personally, I'm not quite that optimistic that we haven't seen all of the fallout from this pandemic yet. So hopefully that's given you some ideas about your own portfolio for 2021. And if you do want to learn more about investing, then you can do that with us by joining our Patreon community. And that's very easy to do. There's a link beside me. You can click on that, or you can look in the description below where there'll also be a link. And if you do that, you get access to lots of member-only content, video content, and you can access our community via the chat application Slack, where you can ask a question anytime you like. And as always, thank you for listening.